Preparing for MBA exams can be overwhelming with so many concepts and questions to cover. That is why I have curated this video containing 5 of the most repeated questions in the term and exam along with their answers. Yes, this video is designed to save your time and boost your confidence. How did I make this list? By carefully analyzing the past term and examination papers so that you won't have to start from scratch. Don't have the time to go through this whole video to find out the answers? No problem. Log into www.anusclassroom.com and purchase the concise, revision-friendly answer scripts that I have prepared for these 5 questions, ideal for some serious last-minute learning. The cash flow statement is like the report card for a company's cash. It shows where cash comes from and where it goes over a period of time. So this first question, explain the basic structure of cash flow statement and describe the meaning of cash and cash equivalents. Discuss in detail the type of activities that are taken into consideration for preparation of cash flow statement. Tests our understanding of the same. To talk about the basic structure of a cash flow statement, you can consider it as being divided into 3 main sections. We have the operating activities, which cover the day-to-day business transactions. So, cash received from customers, cash paid for salaries, rent, or any other operating expenses all fall in this section. It shows how much cash the company is generating from its core business operations. So that is like the core business operations is like the engine of the company, which turns everyday operations into cash. The second section is the investing activities. It includes transactions that are related to long-term assets. Like for example, if the company buys a new machinery or it sells its old equipment or it invests in another company, all of it falls in the investing activities section. So this tells us how cash is being spent or received to grow or restructure the company's assets. Investing activities are all about shaping the company's future. Then there comes the last part, that is financing activities. It covers transactions affecting the company's capital structure. So it includes issuing or repurchasing shares, borrowing or repaying loans, and paying dividends. It shows how the company is funding itself and managing relationships with its shareholders and lenders. After you write down, or after all these 3 sections are put in, we calculate the net increase or decrease in cash. Adding the cash and cash equivalents at the beginning of the period will give us the cash and the cash equivalents at the end of the period, which is the final figure in the cash flow statement. Now, cash and cash equivalents, what are they? Cash is straightforward. It is the money that you have in hand or in the bank. Cash equivalents are short-term, highly liquid investments that can be quickly converted into cash with minimal risk, like treasury bills or short-term government securities. So you can think of them as money's close cousins, close substitutes, almost cash. It can be ready to use anytime, but it's not cash. To summarize, while we are preparing a cash flow statement, we have to focus on 3 types of activities like operating, investing, and financing. These 3 activities we have to focus on. Each of these activity will tell a different story. Like operating activities, it shows the cash from daily business. Investing activities show cash from asset transactions, and financing shows cash movements with owners or lenders. So we can understand from all of this that the cash flow statement is more than just numbers. It helps managers like us, investors, as well as analysts see how healthy a company's cash position is, understand where the cash is coming from as well as going to, and make informed decisions thereby. So understanding all of these 3 sections and the cash equivalence is definitely key to analyzing any company's liquidity effectively. Hey, if you're enjoying this session, take a quick moment to subscribe to Anu's Classroom and turn on notifications so you will never miss an update. Your likes, shares, and even a super thanks or sticker are little boosts of encouragement that help me keep creating and growing this channel. You got any questions, ideas, or suggestions? Drop them in the comments. I love hearing from you and I'm always here to help however I can. Now let's head back. What do you understand by absorption and marginal costing? bring out the major differences among them, and discuss the utility and limitation of marginal costing. Now, this question is about two important costing methods. One is absorption costing and the other one is marginal costing. Both of them are used to calculate the cost of products. But they differ in how they treat cost, especially how they treat fixed cost. Let us start with absorption costing. This method considers both the fixed as well as the variable cost when we are determining the cost of a product. Variable cost like say raw materials or direct labor change with the level of production. Fixed cost like say rent or salary, they remain constant over a period, but they are allocated to products using a predetermined overhead rate. So this means that every unit produced carries a share of the fixed cost, giving a full cost of production. So this is how absorption costing is done. On the other hand, let us talk about marginal costing. It is also called as the contribution margin technique. It focuses only on the variable cost. Fixed cost is treated as period cost and they are charged against the revenue in the same period. So essentially, this method asks what does it cost to produce one more unit? So it is very useful for short-term decision making because it shows the incremental cost and contribution of each product towards covering the fixed cost and generating a profit. Let us look at the major differences between these two types of costing now. Okay, so first, as we said, is the treatment of fixed cost. Absorption costing will spread the fixed cost over the products, whereas marginal costing treats it as an expense of the period. Then the next important difference comes in how they value closing stock. So valuation of closing stock. Absorption costing includes a share of fixed cost in stock, often overvaluing it, whereas marginal costing only considers the variable cost. So sometimes they undervalue the stock. So that is another difference. The next is profit determination. When it comes to absorption costing, profit is sales minus variable plus fixed cost. So you combine the variable and fixed cost, okay, and that combination or that sum you minus from sales. That is how absorption costing calculates the profit. Whereas in marginal costing, profit is your sale minus the variable cost because fixed costs are handled separately. It doesn't factor in our profit. Then the one more point of difference I want to note here between marginal and absorption costing is how managerial decisions are made accordingly, because both methods help in decisions like say production volume or make or buy decisions and all, but marginal costing provides a more sharper view of how costs are going to behave with changes in the output. So why is marginal costing useful? Because it aids in quick decision making by focusing on the incremental cost and revenue. It gives a realistic picture of profitability because as fixed cost is not carried forward. Also, it encourages cost control. It highlights the direct impact of variable cost on profits. So, with all this, it helps with product mix decisions as well because it shows which product is going to contribute most towards covering your fixed cost because that will have the most profit. So is marginal costing all good? No, there are limitations to this also. Like it doesn't give us a full view of the total cost, which is necessary for external reporting under the GAPP. Sorry, GAAP gap. It may cause suboptimal capacity use if the management focuses only on the variable cost and it ignores the fixed costs. In the long run, it is going to cause suboptimal capacity use. Also, it requires accurate estimate of the variable cost, which is most times tricky with the changing technology or market conditions. So in short, we can say absorption costing is better for valuing inventory as well as external reporting, whereas marginal costing is a powerful tool for internal decision making, cost control, as well as profit planning. And understanding both of these is what helps managers make smarter operational as well as financial choices. What is activity-based costing? Discuss the merits and demerits of this system of costing. Explain the application process of this system of costing. So activity-based costing, or ABC, is a modern costing method which assigns cost to products based on the activities that actually consume resources. So that is why it is called activity-based costing. So unlike the traditional costing methods, which often spreads the overhead broadly, like the absorption costing method, activity-based costing traces the costs first to activities, and then it allocates them to products according to how much each product uses those activities. So in short, ABC assumes that activities are the causes of cost and products will be charged based on their use of these activities. So this approach gives a more accurate picture of the true cost of a product or a service. Now let us look at the merits of this ABC, or activity based costing. First, it improves cost accuracy because ABC traces costs at a granular level, giving a clear view of the actual resources that are consumed by each product. So this helps in better pricing, production planning, as well as resource allocation. Also, resource utilization efficiency is improved. How? Because ABC identifies bottlenecks and highlights overused or underutilized activities. So this helps managers optimize the resource usage as well as reduce wastages. It helps in better product pricing because cost is allocated more precisely. So pricing becomes more accurate, and this will improve the profitability as well as the competitiveness. It enhances decision making by providing a detailed understanding of cost which is associated with each product or service. And thus, it supports better decisions on product planning, capacity use, as well as allocation of resources. Then comes identification of profitable products. Because ABC can reveal the true cost structure, it shows which products actually contribute to covering fixed cost and generating profit. Of course, ABC is also not something without challenges. Some of the demerits of ABC costing include increased complexity. How is it more complex or more complicated than traditional costing? Because it can raise implementation as well as maintenance cost. It is not an easy task to map what you can say cost to activities and then cost these activities to products. So the complexity of estimating the cost, that becomes more than the traditional methods. Also, there are data collection challenges. Like accurate ABC requires a detailed data on exactly how resources are consumed by each activity, which is again a time consuming process. Also, there could be resistance from management because ABC can expose inefficiencies or any kind of hidden cost, which some managers may resist acknowledging. Also, there could be time and cost of implementation issues because, as we said, setting up ABC demands effort. It demands its own resources and a thorough understanding of all the organizational processes. Also, there is a difficulty in external reporting because ABC may not always align with the GAP principles, making it less suitable for external financial reporting. Now, finally, before we wind up the answer to this question, let us go through the application process of ABC. The first step is to identify activities. So that is, you have to list all the key activities in the organization and you have to categorize them based on their cost drivers. Then you have to determine the cost drivers. That is, you have to identify what causes the cost for each activity. Like say, for example, is it labor hours or machine hours or material usage? What causes the cost for each activity? Then you have to determine the activity cost. That is, you have to calculate the total cost of each activity, including both the variable and the fixed cost. And you have to allocate the activity cost to the products. That is, you have to distribute the cost to products according to their usage of each activity. Predetermined overhead rates or other allocation methods can be used over here. And then comes the final step, that is review and adjust. ABC is also not static. Regular review of the system is required to reflect changes in the process, technology, or market conditions and make it accurate, keep it accurate as well as relevant. So in short, ABC is definitely a powerful tool for understanding the true cost of products, also for improving pricing decisions and optimizing resource use. But it is a complex process. It requires effort to implement. But keeping all of that aside, the insights that it can provide can make a significant difference in managerial decision making as well as profitability. What is a budget? Briefly discuss the types of budgets that would be prepared by a typical business concern. Discuss the significance of budgetary control in modern organizations and describe the control ratios that are used for this purpose. So, a budget, as you all know, is essentially a quantitative plan that is usually expressed in financial terms. It represents an organization's future plans for activities, expenses, and revenues. So you can think of it like a roadmap or a blueprint for the company. It helps plan resources, minimize waste, and uncover inefficiencies within the organization. Now, in a typical business concern, budgets are broadly classified into two main types. One is the capital budget, the other is the operating budget. Capital budget focus on proposed expenditures for new projects or major investments that often require special financing. Capital budgets help the organizations to decide whether they have to invest in long-term assets or launch new initiatives or expand their existing operations. Coming to operating budgets, these are more short term. It is to deal with the day-to-day expenses and revenues of the organization. So they provide a framework to manage resources efficiently and ensure that the organization operates within its means. So essentially, operating budgets guide the routine functioning of the business. Now let us talk about the significance of budgetary control in modern organizations. So budgetary control is that process of comparing actual performance with budgeted plans. It is going to help organizations allocate resources effectively, manage their cost, and evaluate the performance. So by identifying the variances between actual and planned results, managers can take corrective actions promptly. So this not only fosters accountability, but it also improves the decision making and supports overall organization growth. Now, to make budgetary control more effective, organizations have to use what is called as a control ratio to measure the financial performance. Some of the common control ratios include the liquidity ratio, solvency ratio, profitability ratio, and activity ratio. Let us look at these in short. Liquidity ratios assess an organization's ability to meet short-term obligations. So, examples of liquidity ratios that you can quote are current ratio or acid test ratio. Current ratio uh, is obtained by dividing the current assets by the current liabilities. Acid test ratio is how you get it is by dividing quick assets by the current liabilities. Solvency ratios measure the long-term debt repayment capacity. So examples of solvency ratios include the debt to equity ratio, which is found by dividing the total debt by the shareholders' equity, as well as times interest earned ratio, which is uh, understood by dividing the earnings before interest and tax by the annual interest expense. Profitability ratio assess the return on investment. So examples Profitability ratio assesses returns on investment. So examples include the gross margin ratio, which is found by dividing the gross profit by the sales revenue, or the operating profit margin ratio, which is obtained by dividing the operating income by the net sales, or the return on assets ratio, which is obtained by dividing the net income by the total assets. Activity ratios evaluate how efficiently the organization uses its resources. So, examples of activity ratios include inventory turnover ratio, which is found by dividing the cost of goods sold by the average inventory, or receivables collection period ratio, which is obtained by dividing the accounts receivable by sales per day. So, these are all the budgetary control ratios which we can use. By monitoring all of these ratios that we discussed, the control ratios, and by monitoring them regularly, organizations can identify trends, assess performance, and make informed decisions to improve the financial health of the organization. So, in short, a well prepared budget, when it is combined with effective budgetary control, ensures that an organization not only plans its activities efficiently but also stays on track to achieve its financial and operational goals. What is an annual report of a company? Explain the various heads in which non audited information is provided in the annual report and discuss the significance of such information. So, the annual report of a company is a comprehensive document that companies, especially the publicly traded ones, prepare and share with their shareholders every year. It is much more than just numbers. It is a window into the company's performance, strategies, and future plans. Stakeholders like investors, analysts, employees, suppliers, and customers rely on this report to make informed decisions, like maybe it is investing, lending, or doing business or seeking employment. At its core, the annual report contains financial statements which show the company's financial performance over the years. So these include income statement like showing revenues, expenses, and net profit, balance sheet like listing assets, liabilities, and shareholders' equity, or cash flow statements illustrating cash inflows and outflows from operations, investing, and financial activities. And along with all of these, the report also includes notes to accounts, which explain the accounting policies, the assumptions, and other details that are not obvious from the statements themselves. Then comes the auditor's report. This is where an independent auditor gives an opinion on whether the financial statements fairly represent the company's financial position according to the accounting standards. And beyond these audited sections, there is a very important part, that is non audited information. So, this non audited information, this section provides the qualitative insights about the company, and it is divided into several heads like the chairman or the CEO's letter, the business overview and strategic reporting section, the corporate governance statements, the environmental and the social and governance reporting, or the ESG reporting, such things. Coming to the CEO's letter or the chairman's letter, here the top management shares what achievements they have done, what challenges they faced during the year, what are the strategic initiatives that they took, and what are the future growth prospects for the company. So it is like a personal roadmap from the leadership to the stakeholders. Then, in the business overview and strategic reporting section, it describes the company's operations, the key products or their services, the market positioning, the competition, and major milestones that they achieved. In the corporate governance statement, here it highlights how the company is managed, the board composition, the director responsibilities, and governance practices that ensure the transparency and accountability of the organization. In the ESG reporting section, or the environmental, social, and governance reporting section, this is an increasingly important section where we have the details of the company's environmental impact, social responsibility initiatives, employee welfare programs, community engagement, as well as sustainability practices. Other non audited information may include forecast or dividend policies, the risk factors, or any other recent developments that management feels is important for stakeholders to know. So, why is all of this non audited information significant? Because it complements those financial statements by providing a holistic view of the organization. While numbers tell one side of the story, these qualitative sections reveal the company's strategies, the management quality, the risk profile, and the long term growth potential. So, for investors, analysts, or any other stakeholder, this information is crucial in evaluating whether the company is well managed, whether it is sustainable, and whether it is aligned within their interests. So, in short, the annual report is not just any what you can say a statutory requirement. It is more of like a tool which informs, guides, and builds trust between the company as well as its stakeholders. The non audited section, in particular, turns the raw numbers into a meaningful story about the company's performance, its vision, as well as future direction.